If you had €250,000 to invest in a short-term rental property in Europe, and your goal was maximizing revenue rather than prestige or market size, which cities would stand out? In this video, we rank 10 locations based on realistic indicators like nightly pricing, occupancy trends, entry property costs, and regulatory climate. These figures represent market-informed estimates rather than guarantees, but they reflect where yield potential tends to be strongest today. Let's begin with number 10, Berlin. This budget typically buys a small apartment in emerging districts. With nightly rates often around €130 to €150 and occupancy near European averages, gross annual revenue may reach €25,000 to €30,000. Regulation exists and requires compliance, but strong cultural tourism keeps demand stable. Number 9 is Lisbon. €250,000 can secure a compact apartment outside prime central zones. Nightly rates around €120 and healthy occupancy can produce roughly €25,000 to €30,000 per year. Licensing requirements are stricter than before, yet global demand and remote worker inflows sustain pricing power. At number 8 we have Athens. Entry costs remain relatively accessible, allowing purchase of renovated central apartments. With average nightly pricing near €110 and solid occupancy, annual gross income often lands between €20,000 and €25,000. Tourism growth and affordability support its yield appeal. Number 7 is Porto. Property costs are often lower than Lisbon while tourist demand remains strong. Nightly rates around €120 and good booking levels can deliver approximately €27,000 to €32,000 annually. The balance between entry price and demand gives Porto a strong yield profile. Number 6 is Valencia. With growing tourism and comparatively moderate property prices, investors often find attractive ratios between purchase cost and revenue. Nightly pricing around €120 to €130 with solid occupancy can produce about €28,000 to €33,000 yearly. Regulation is evolving but still workable. Number 5 brings us to Florence. High global appeal drives strong nightly pricing, often well above €180. Even with moderate occupancy, gross revenue may reach €30,000 to €35,000 annually. Property selection is key, and regulation is tightening, but pricing power keeps yields competitive. At number 4 is Barcelona. Licensing limits create barriers, yet legal properties benefit from strong demand and nightly rates often above €200. Revenue potential frequently reaches €35,000 to €40,000 annually. Investors must carefully navigate rules, but earnings can be significant. Number 3 is Rome. Strong year-round tourism allows nightly rates around €180 or more and occupancy levels above 60% in many areas. Gross annual revenue around €40,000 is achievable. Regulation and competition are real factors, but demand depth supports returns. Number 2 is Paris. Exceptional nightly pricing often exceeding €250 supports revenue frequently above €40,000 annually despite strict compliance requirements. Entry is complex and property sizes are smaller, yet the city's pricing power makes it one of Europe's top earners. Taking the number 1 spot is London. With nightly rates around €200 or more and strong occupancy driven by tourism and business travel, revenue potential among properties in this budget range is among the highest in Europe. Gross income can exceed €40,000 per year. Combined demand diversity and relatively flexible operational limits keep it at the top for yield potential. Short-term rental performance always depends on property selection, management, financing, and compliance with local rules. But comparing pricing, demand, and entry costs reveals where capital can potentially generate the strongest revenue across Europe. Consider which destination aligns best with your strategy, and thanks for watching.